Until noon, you're listening to Neil Mitchell.
133693. Ross MacDowell is our bright and nice burger, but he's an economist, runs a podcast called Burgernomics. Now, Burgernomics is designed to bring it all back to basics, and what does all these economic movements mean to the price of a hamburger? So this is a version of the pizza test. Ross MacDowell, morning.
Morning, Neil.
Okay, what's going to happen with interest rates?
Very great analogy to use for this. It's all about a house brick and an elastic band, Neil.
Yeah.
The house brick is consumption. Everybody buying things, and that creates inflation when they all want more things, and there's lots of money about, so we can afford to buy more things. The Reserve Bank has to keep inflation down, and so it does that by increasing interest rates, and it's done that a hell of a lot lately. Interest rates are the elastic band. Put the elastic band around the house brick, start pulling it, which is an interest rate increase.
Yeah.
Nothing happens. Have another one. Nothing happens. Have another one. Nothing happens. Keep on going. And then all of a sudden, the brick gives way, Neil, and it doesn't move slowly. It takes off and smashes into your knuckles and you're bleeding. And that's what's called a hard landing for the economy. And that's what the Reserve Bank's trying to avoid doing, but we've certainly had an interest rate increase every month for the last 8 months. This will be the 9th month. We've gone up 3%. If you look at the actual effect upon, let's say, a $600,000 home loan mortgage, that means that that family's having to find $12,000 and a bit more in their after-tax dollars just to stay where they are. Now, they're not going to get a 16% pay increase, which would compensate for that, plus they've got this inflationary effect of all of the things they're having to pay more money for, let alone that increase in the mortgage. So what the Reserve Bank does today, I think they'll be doing very carefully, and I think they've been heavily criticised before for going too hard.
A couple of questions out of this. The banks were both the major banks, well, two of the major banks were telling me through the period where they were lending heaps of money because it was so cheap and people were overcommitting on houses. And I'd say, what happens when the interest rates go up and people could end up with negative equity? They owed more than the house was worth, or they couldn't service the mortgage. And the bank said, no, that's not going to happen because we're being careful. We're building fat in. We won't lend money if that's a danger. So if the banks did that, why are we saying that there are people in mortgage stress, people who've got to sell?
Well, I mean, there's been several instances in Australian history where there has been negative equity before in people's home situations. So it's not a new thing. It's more that I think that for the last 25 or 30 years, we haven't been in these situations. So it appears to be a new situation that we've never had to confront before.
But why are people in trouble if the banks were saying they wouldn't lend to people who were going to get into trouble?
Because if you think about years and years ago, Neil, when you and I bought our first house, it was basically 30% deposit and you had to pay 30% of your monthly gross income as a repayment. All that's changed, hasn't it? People wanted houses. The banks decided that they want a bigger share of that sort of loan market to make more money to please their shareholders. The Reserve Bank was very happy to generate that with giving them more money. And so the lending situation changed quite a lot. Now it's reversing. The government authority that's in charge of lending has made it a lot easier.
Jeff has a question. Yes, Jeff, go ahead.
Yes, I'd like to know why, to stop inflation, the banks have to get more money off the poor buggers who've got a mortgage.
Well, I think I know the answer. Thanks, Jeff. What do you say, Ross?
Look, what's happening is with the banks, they're simply responding to the interest rates that the RBA is setting. The RBA is setting interest rates because they've been told that we've got inflation at 7.8% and then they need to get that back. They get that 7.8% from the Australian Bureau of Statistics, and that's a 4-month-old.
Yeah, but the theory is, and I think Jeff's question is, the theory is that if you are paying more on your mortgage, you're spending less on other things, and therefore inflation isn't going up because you're not spending as much. Correct?
Correct, absolutely. And I'd be interested to know what your listeners decide to cut back on when they hit this great mortgage cliff that appears to be looming.
Well, that's my
What's gonna
point.
be the
I'm not
first-
sure how many people are headed for the mortgage cliff because the banks say they were being careful in their lending.
Well, if everyone's going to have to go from a proportion of fixed mortgages, fixed and variable mortgages, to more variable mortgages, boy, they're going to be paying more money.
Okay. Andy, yes, you got a question, Andy?
Yeah, they're trying to curb spending. Why don't they just lift the GST temporarily so everybody who's actually spending the money is being penalised rather than the homeowners?
Thank you, Andy. It's an interesting one. Ross?
GST is probably more of a political situation than it is an economic situation, and it's just governments want to stay in power. They're not going to do things that are politically going to shoot themselves in the foot, especially a Labor government, because they believe it'll penalise their very voters.
Okay.
So I don't think the GST will ever really appear in my lifetime.
Peter? Yes, Peter. Go ahead, Peter.
I'm just saying that a lot of the people that have got mortgage problems have brought it on themselves by over-committing and buying properties. They might be just a couple and they end up building these 50-square houses or buying a 4-bedroom house in an area that they can't really afford to and they don't need.
Over-committing.
Over-committing, yeah, definitely.
Well, you see, David, that's part of the point that I was making and a lot of people were making in 2020, 2021, as house prices were surging and banks were throwing money at people cheaply. I kept saying, interest rates will go up. You know, you're going to get caught sometime. I don't know. Ross, the other thing, the CPI, how they assess the CPI, they change regularly, don't they?
They do. The CPI traditionally has been a quarterly figure of which the Reserve Bank has based their interest rate decisions upon. If you have a look at that, it's 4 months old, 4 months out of date, when the Reserve Bank have to make their decision. The Reserve Bank, most other economists will say it takes 6 months for a rate decision to take effect. So you're looking at a 10-month lag period. Well, the whole economy is completely changed within that 10 months. And so it's out of date before it begins. So then the Australian Bureau of Statistics says, okay, we will go to a monthly figure, which every other economy in the world has monthly figures. Well, then they say the monthly figure only includes 62% of the things that we really want to know about anyway. So I think there's a lot of work that needs to be done to make the information that these rate decisions are based on more relevant.
I guess the point is there, and a lot of people will too, does the CPI figure, does it accurately reflect how people are feeling and suffering inflation?
Absolutely not. I mean, if you take a guy that's out there, throw a family out there that's mortgaged to the hills, or the rent's gone up, they've got 3 kids at school, maybe they're drinking a bit of grog, they're having a couple of fags in the car on the way to work to try and reduce the stress, they're going to be paying a whole lot more than 7.8% in terms of inflation, according to the basket of goods that relates to the CPI. If you're an older person, you put the kids through school, so there's no more fees, you don't smoke, you don't drink, you're not doing a renovation, you own your own home, well, 45% of the basket of goods is completely irrelevant to you.
All right, final question, and it's your question. What does this do to the price of a hamburger?
Well, Neil, hamburgers, I think sales might go up because a lot of people might be struggling out there, and rather than that flash dinner they take the family to on Friday night, they might be dropping by their local hamburger store to sit down outside on the picnic tables in the local park.
Good to talk to you. Thank you. Ross MacDowell, who we first talked to as an iceberger, but he runs a podcast. He's an economics graduate at Monash University. He runs a podcast called Burgernomics, which tries to bring all matters of economic complexity down to the price of a hamburger. And it's a good idea. Let's simplify it. And the CPI has annoyed me for years. When you look at the CPI, I say, hang on, that's not a true representation of how people are feeling about inflation. 133 693.